Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, where I continue my conversation with Marc Malek, the founder of Conquest Capital Group.
How to allocate within the different risk environments and so on.
So you have these four strategies inside the macro program. Are you able to kind of visualize and talk just briefly a little bit about how each of them, what they do, so to speak? Just to make it sort of maybe simplified a little bit?
Well, like I said, in the sense of in looking at sort of our long vol component,
right?
I mean, all trades that we do are, in the case of Conquest Macro, we have about 35 different markets or so.
Okay.
And in each one of those, in each one of those risk buckets, we're looking to extract a certain profile in the market. The way I think of the way these strategies interact is essentially at the root of get us started into a different topic.
Okay.
But in a nutshell, I mean, I think historically trends used to happen. Well, trends happen because information comes out at different times,
right,
and causes market to move.
Mm-hmm.
Now, if you go back in history, 20 years or so, information came out very slowly. Different people got it at different time and reacted to it at different times and created the trends that created. I think and that was great for long-term trend following. I think as we got to the end of the 90s, beginning of the 2000s, with the advent of the technological revolution, with the telecom revolution, with all the advances that we've made on the internet and so on, the effect of that on the market is that it caused the way markets to move to go from a much more sort of continuous function where it was somewhat of a smooth movement over time,
right,
that was based on different people getting their information at different time and reacting to it at different time, to an environment where pretty much everyone that wants any kind of information gets it at the same time and reacts to it at the same time.
Sure.
So visually, if you want to think about it, think of about, let's say a market is going up and it's going from point A to point B. In the old regime, it would go from point A to point B in a nice upward sloping, smooth curve.
Right.
In the new risk regime, it replaced that with more like a step function, where the market goes, into a flat period where nothing is going on. A news comes out, everyone reacts to it at the same time. It causes a big jump, which is that up part of the step. By the time everybody reacts and the market absorbs that reaction, it flattens up again until you get the next news event, which again will cause it to almost gap either up or down and then stay there and continue. It's not really gapping in the type of markets that we trade, but a very sharp move. Now, what we try to do is they say we're still looking at the same shorter. I mean, the average holding period in Conquest Macro is about 6-7 days.
Yeah.
So we're still kind of looking at the same movement from point A to point B, but we're trying to capture it through the different activities that cause that movement. So in the part that is flat, obviously there is nothing you want to do. You want to try to be out of the market. I say if you think of it as a staircase, in the flat part of the staircase, you really don't want to do much there. On the spike up, when that news event happens and causes the market to spike up on the top part of the stair, what you want to do is you want your long volatility component to come in and capture that expansion in volatility. Now, that's how we capture that.
Right.
Now, while that's happening, there are some counter trend moves that happen in the market sometimes. So we try to capture those with our counter trend strategies. I mean, in that case, let's say instead of the steps continuously going up, you can have 3 steps up, then 2 down, then another 3 up.
Right.
So we have, and again, radio probably would be a lot easier to explain this with a board and some charts.
But you want to buy the dips in an uptrend, or you want to sell the spikes in a downtrend?
Both.
Yeah.
That's essentially what how we try to achieve the returns that we do.
Yeah.
Which is, we have, over 75 different models with, decent, not high correlation to each other.
Yeah.
Each one is trying to do different things. So we rarely try to, whenever we try to buy the dip in a market, we do it in a way with a very tight stop, because overall we don't want to take away from our profile of being long volatility.
Right.
But you can buy that dip in a combination of ways, either through taking profit on existing position or establishing a new position with a very tight stop if the dip is at an interesting point in a trend development and so on. But essentially, we start with what we believe is kind of the blueprint of how markets move. And then we try to create different models that take advantage of the different parts of that movement.
Yeah. Let me ask you something. Well, maybe you get a sip of water because you're doing most of the talking today. But let me ask you a slightly different question. When I hear you talk about this, clearly what you've built is a complex system, if I can call it that, with lots of models, lots of moving parts. And in my own personal experience, we've certainly tried to build short-term systems and using many different market model combinations. But what we found in our research was actually that the more models, even though they were lowly correlated or negatively correlated, but the more of these things we threw into the overall program, it didn't actually help us a great deal. And that sometimes simplicity is not a bad thing. How do you view that? Or let me put it this way, how do you balance the complex versus the simple?
Very simple. Each model by itself is actually not that complex.
Right.
There are a couple of ways you can build trading models. You can do what I call the trolling approach, which is you test different algorithms and trading strategies, and whatever works, and then you use it. And you use it until it stops working, and then you stop using it. A lot of people do this. There is absolutely, nothing wrong with that approach. People look for pattern recognition all the time in the market and try to take advantage of those patterns. My problem with that approach is if I don't know why it's working, I will not know when it will stop working and might end up really overstaying my welcome in that strategy. So we use a slightly different approach to strategy building or model building, which is that if you can't explain it in English, to a reasonably intelligent person and have them get the idea of why it works, then we don't really want it. And then, for each model that we have what I call sort of we've identified over 60 different statistical variables that we use as diagnostics for each model on a daily basis. And then we look at, obviously, the 1 week, the 1 month, and so on, to make sure that the model is still behaving in the same way that we expect it to. However, like you very correctly said, if you come up with 100 different models that do all these different things, you throw them together, at best, you're going to end up with zero return a lot of the time. You end up really hurting yourself in some cases.
Sure.
And because for a couple of reasons. One is if you add a lot of complexity in a model, you're probably overfitting and it doesn't work. And if you have too many different models, just kind of dilute your returns, basically. You end up, spending a lot of money making your brokers rich. So the way that we've gotten around that problem is by not always allocating to all these different models. So what we have is we have a lot of different models that do different things, but because of our reliance on the risk environment and various other factors, what we do is we're constantly turning on and off models based on our read of the market conditions in which they work or not work.
Right.
Yes, you're correct. If you just throw a lot of models in, very complex model, you're going to eat away your return and have negative expectation from that addition. But that's not what we do.
Right. And let me just ask your thought about this. I don't know whether you have an opinion about it. I think it's important for the listeners to understand, because clearly a lot of people are really trying to grasp, what you do, but also generally speaking about these type of systematic approaches. And here's the thing: you can come up with, say, 50 different market model combinations, and each of them look good and have a decent risk return profile. And for all things being equal, if you put them together, you should get, on paper, it looks stable and robust. But I think what people need to understand is that what can happen is that you're talking about, say, in this case, 50 different return streams and 50 different streams of trades that are either going to be profitable or unprofitable. But what can happen, which we don't know, is that in the future, the way these trades occur can happen so that you get a concentration of losing trades just happening at the same time. And that's where the drawdown comes from. It's not necessarily that the models themselves are bad or have changed, but it's just the way that the returns or the trades come along, and you get a concentration of losing trades, and therefore that's where your drawdown comes from. Is that a fair way of describing the how these things can?
Oh yeah, absolutely. But I mean, before we add any model to our portfolio, it goes through very rigorous checks of simulating different market condition, what trades at the extremes, how big it's going to make, our positions vis-a-vis the other models that we have. So we try to do as much of that work as we can beforehand. But even then, markets have a way to surprise you. So even then, what we do is on a portfolio basis, then we have different sets of risk management tools that will make sure that we never go above the max position in any one sector or market, whatever that we want.
Yeah.
So, we try to capture it both from the construction, but then also from, the overall portfolio side.
And is the macro program, I guess it's an intraday program in the sense that your short-term trading does rely on continuous data and being able to react at any point in time, or are you able to? Okay.
Yes. No, we trade. We continuously trade. Throughout the day and the night.
Okay. I want to jump to another section, which is more on the topic of risk management, because one thing is to put the models together, the other thing is to manage the risk. And you just mentioned you have some limits for each of the things, but let me ask you more broadly. How do you define risk? What is risk in your view, and what should the investors be looking at? Because I think you've alluded to this, and that is that maybe a lot of people look at a certain risk number and they feel good about it because the value at risk is such and such. But what they don't realize is that value at risk changes, and when it really gets into hot water in the markets, value at risk is not very useful. So how do you deal with that?
I think value at risk is the worst thing that happened to markets because it gives managers or investors a false sense of understanding of the risk.
Right. So I didn't overstate that then.
No, absolutely not. I mean, look, I look at risk in a couple of ways. I look at risk in terms of upside deviation versus downside deviation in our portfolio. I look at it in terms of our max expected drawdown, and I look at it, in terms of what could happen given various different movement scenario based on the individual volatility of a given market and the correlation to the other markets that we have to the portfolio and when we have a max position. So you want to look at individual position, then you want to look at the correlation of these positions, because it's one thing to limit, one market, but there are one thing we know. I mean, correlation, again, is one of, I think, the most misunderstood statistics out there. You have a lot of people kind of hate looking at correlation because they think it's unreliable, because correlations break all the time.
Right.
But again, what we found is that actually correlation, when you look at it the right way, is one of the best sort of stats that you can measure in terms of fidelity. The problem is that people look at correlation across a variety of risk environments.
Right.
So when you look at a 10-year correlation over a 10-year period of, let's say, a couple of markets to each other. Now, over that 10-year period, it's a constant ebb and flow between risk-seeking periods and risk-averse periods. And what happened is that correlation of, let's say, those two markets that you're looking at is very different in risk-seeking periods than it is in risk-averse periods. And again, to use the example we spoke about earlier, between strategies, let's say, that rely a lot on liquidity, what happens to it when liquidity disappears versus one that, not as much. So what we found is that if you actually look at correlation, break it down from, let's say, you're looking at a 10-year period. Over that 10-year period, instead of looking at the overall correlation, you look at the correlation in risk-seeking periods, and then you look at the correlation in risk-averse periods. You get a much more accurate and a much more predictable and much more sort of true measure of correlation.
Yeah.
So what we do is we not only look at an overall number of correlation, we subject all these tests to, again, further tests, looking at them in different risk environment and so on. But again, the only thing that we can control in that whole equation is how much risk we're willing to take. We can't control the return side of the equation because, depending on what the market gives us, is how much we can how much we try to return based on the strategies that we have So we try to minimize the max drawdown, obviously, to a point that, again, I mean, roughly back of the envelope calculation, I think a reasonable expectation is what I call kind of 15% return, 15% vol, 15% drawdown, max drawdown.
Right.
I think that is a good guideline. Over, if you kind of look at different windows, those numbers can vary. But looking at a long enough period, I think that would be a good sort of record to have.
Yeah. Oh, no, that would be a terrific record. I think most trend followers would be envious if they could keep
I mean, again, it's just to make sure that everybody understands, this is not for trend following. This is for Conquest Macro, which is sort of our 2 and 20 product, and not the trend follower, which is the 1 and 0. So in the case of Conquest Macro, we really do try to provide some alpha. That is very different than sort of simple trend following.
Do you look at loss to stop as a measure? And I'm asking this because I'm assuming you use stops for your trades, but I'm not even sure because I didn't ask. Okay.
No, we for every trade that we do, we have a stop associated with that trade.
Okay.
And in a significant number of our trades, we also have take profits based on price level. We have time stops. We have stops based on volatility. So we use stops not just as losing sort of technique where you limit your losses, but we also use them a lot to as take profits and vol stops and time stops and so on.
Yeah. I mean, I think personally, I find that looking on a daily basis at what's the worst that could happen if everything got stopped out today is a good measure of risk as well. And I'm not a big fan of the value at risk, but I think it's worth pointing out to the audience that when looking at managers and using your analogy about correlation and risk seeking and so on and so forth, I think what investors should really pay attention to is to actually look at the correlation in managers in negative month and in positive month, and not look at just correlation in overall months, because that doesn't really say anything, in my opinion.
Oh, absolutely. I mean, and look also, when looking at some of these stop losses, I mean, yes, you want to look at what happens if every position that you have stopped out on that day, except that sometimes in cases where markets are negatively correlated, let's say you take a simple example of your long bonds and let's say your long bonds and long stocks. Those are trades that are working in a way in most of the time end up working in different directions. So the probability of you getting stopped out on both on the same day tend to be fairly remote.
Absolutely. Yeah, no, I wasn't actually thinking about the probability as such. Just, people should be comfortable, and I think investors should be comfortable with, what could happen if my manager got stopped out of everything, regardless of, whether it was up or down.
But it's not, it can also, insofar as your tolerance for the stop is going to affect your position size and your risk taking, and you want to be very conservative in how you measure the risk, but there is such a thing as being kind of overly or unrealistically conservative in the sense that, again, one of the reasons why, I hate value at risk is that it automatically assumes sort of, a blind approach of shocking the portfolio on let's say you're looking at a 3% move or a 4% move or so on. Well, for very long-term strategies, maybe that works. In our case, our stops are, within usually half a standard deviation. So, by the time the market moves 3-4% or 3-4 SDs, we are long gone out of our position. So it's a completely irrelevant number. So when somebody kind of, looks at a snapshot of our portfolio and brings me a VAR number based on a 3 SD move, it's completely ridiculous. It's meaningless because we trade only the most liquid markets in the world. So the probability of a gap in any of our markets is almost non-existent. Matter of fact, I don't remember ever happening since we traded. So given that our stops start within kind of half SD of where we are and probably end at 1 SD, why am I looking at the losses on the full position from the 1 to the 3 SD mark?
Yeah.
So you want to be very conscious of your risks and all different, on position size, on, everything getting stopped out. But you also want to do it with somewhat of a common sense approach.
Sure. No, that's true. I want to jump to, I've got a couple of sections left that I want to talk to you about, and we're not going to go into every single question because we want to sort of keep time to a certain level at least. But I want to talk a little bit about drawdowns. And, often investors get very uncomfortable during drawdowns. And it often causes them to redeem, probably very close to the worst drawdown of any manager. I want to ask you a little bit about how do you as a manager, when you look at your drawdowns, how do you know if something more fundamentally has changed and therefore you need to adopt, or adapt, maybe is the right word, your strategy? Because what we've seen, certainly in the trend following space, is that since 2009, even strategies that have been doing well with a certain drawdown profile for 10, 20, even 30 years, suddenly the drawdown profile has changed in the last few years, and many people have recorded larger drawdowns than they have prior to that. So how do you view that?
A couple of things. I mean, first, there really is nothing new about what's happening now in a big picture than what happened before. Of course, the way a max drawdown happened is, I mean, it's going to sound stupid when I say it, but it's because you made a worse drawdown than the last one.
Right.
Well, yeah, I mean, that's sort of, at any point, I mean, if you go back to a lot of these strategies prior to, 2009, you will see a point in which, they made a drawdown, then they rallied, made a lot of money, and then they probably made a worse drawdown. So they hit a new low in their drawdown, but they came back and made more money. And now they hit, maybe another lower low in their drawdown. And my view is they will come back and make money, because fundamentally, I don't think anything has fundamentally shifted in the way markets work. I mean, we have seen a temporary shift, which is in this overly active intervention of the Fed in the markets.
Sure.
But this is, in a way, what they're doing is not new, because the Fed always intervenes in the market, all the way from kind of the open intervention when they try to manipulate currency markets by intervening in the currency market, to changes in interest rate, which really is, part of their mandate, but it's still an intervention. What they did this time is they took it to a new extreme.
Right.
It's not unexpected that new extreme caused, a corresponding new extreme in strategies that, don't benefit from these interventions. But, at least in the US, we are seeing the beginning of the unwind of that sort of very, that level of activity on the side of the Fed. So, I have every expectation that, my own personal view is, we've really, rather than try to solve the problem that caused 2008 here and in Europe, we've tried to throw a lot of money at the problem. We haven't fixed any of the problem, but now we're short all that money that we threw away at it, and we're still left with a bigger problem.
Yeah.
So my own expectations, I think, the trend followers are going to come back and actually have probably a much better year than they've ever had before, should be commensurate with having a worse drawdown than they ever had before.
Yeah.
Now, that's not, maybe that's part of the question you asked, but let me answer of how we deal with this in Conquest Macro. For every model that we build, and then that model becomes part of a sub-strategy. So, and then for every sub-strategy that we have, and then that sub-strategy becomes part of the portfolio, and then for our portfolio, what we do is, what I mentioned earlier, is we've identified over 60 different statistics that we use them as almost like diagnostics. So what we do is, take, a number of winning trades or losing trades, any one of those stats, let's say. What you do is you have a running total of these stats. You build the distribution for these stats. Then on each day, you go and you calculate that number for that day, and you see if it fits within the distribution. Now, in addition to that, what we do is for every model that we build, and again, for the sub-strategy, the strategy, the portfolio, we build a beta version of it. So what's a beta version? So for example, let's say I have, a short-term trend following model in Conquest Macro that has a 7-day average duration. Well, I know that something as simple as a 5-day breakout strategy. Right. Roughly, if you want, kind of the formula between holding period and end day breakout is that for an end day breakout, it's going to have a holding period of 1.5 N. So roughly a 5-day breakout is going to have a 7.5 day holding period. Right. So really, the beta of my macro short-term trend following model is going to be a 5-day breakout on exactly the same market in the same proportion. Yeah. So let's go back now and say, okay, well, when I look at on a daily basis, I look at these diagnostics for every model that we have and sub-strategy and portfolio and so on. Now, when you're looking at over 60 different stats, the chances are that any given day you're going to get a few of these stats that are falling outside of the distribution, which is really nothing unusual because that's how distributions get built.
Right.
Now, where I start to worry is if a cluster of the stats start to break, if a very large number of these stats start breaking. Now, mind you, right now, I'm not looking at any return, whether it's making money or losing money. We're not even looking at any of this. We're just looking at the stats.
Yeah.
And these stats can break both because it's making too much money or losing too much money or not making any money. Now, once we've determined that model is behaving differently than our expectation based on those diagnostics, the first thing we do is we go to the beta version of that model. Say, well, what is the beta doing? If the beta version of that model is displaying the same breaks in these diagnostics, then what that tells us is that this break is much more likely being caused by a change in the way markets are behaving rather than the way our model is behaving.
Okay.
So then that gives us a comfort level that the model is not broken, but then it makes us go and take a look at the market to see if there is anything that has changed in the market.
Right.
Now, 99 times out of 100, nothing has changed in the market. And again, these distributions happen because different things happen at different times, and they get to build these distributions. And then, they end up coming back and correcting themselves. However, if, in cases, we've had cases where we've decided to shut down a model or shut down a market because of this. So, for example, looking at, I'll give you sort of a very obvious example, but, trading Euro-Yen futures in Japan is not really a good idea in a short-term trading model these days.
Right, sure.
Because something had fundamentally changed in the way that markets trade.
Yeah.
Or, for example, sometimes in a given model, if we start seeing breaks from the beta, where the beta is behaving a certain way that's still sort of, in our expectation of how it should behave given the market condition, but our model is not, then kind of goes on the operating table and, we try to sort of dig deeper, and we have no problem killing a model if we think it's not behaving as we thought it should.
Sure.
And anyway, to counter for that, what we do is whenever we introduce a model, we never introduce it, fully into the portfolio. So, even after the model makes it to, from the research phase into ready to go into the portfolio, it goes through 3 months of paper trading without any money.
Sure.
If it survives that, then another 3 months in the portfolio at a quarter weight. Survives that, then another 3 months at half weight, and so on. So it's not until over a year's time that will go into the portfolio at full weight, and even then, it's one of 60 or plus different. So it's we do a very incremental approach to this stuff.
Sure. It makes sense. Now, there's an intellectual side to drawdowns that we've just discussed, but there's also an emotional side. And how do you deal with drawdowns from an emotional side? How have you learned to?
Well, look,
detach?
if your strategy, if nothing fundamentally changed in the market and your models are not broken, then a drawdown is the perfect place where you should double down.
Sure.
Now, obviously, we don't do that.
Sure.
Look, in being a money manager or a hedge fund manager or a CTA, 99% of the time, you're sort of, your interests are aligned with your investor's interest. Where, whatever you do something that is good for you, for your business, and for your investor. A drawdown, as you correctly mentioned, is a very emotional issue. And that's really the one time where I think managers, including us, do something that feels better for the investor, but probably not in the investor's best interest.
Right.
Which is cutting positions in a drawdown and reducing risk in a drawdown. Investors demand that you have some drawdown mitigation technique. And, within our fund, we have, hurdles where if we hit X drawdown, then we cut the position by this much.
Sure.
And if we hit Y, then we cut them even more, which is, I'll be the first one to say it, not the best portfolio decision, but it's a business decision, and it's something that investors ask for.
Yeah.
Now, I'll also tell you that we have very large managed accounts where investors choose that they don't want to do that.
Right.
So either they come and add themselves, or they ask us not to cut positions in a drawdown.
Sure.
But I would say it takes a very astute and an investor who really understand your strategy not to want that.
Yeah. No, absolutely. Just a final question about sort of drawdowns and risk and so on and so forth. Is there anything that keeps you awake at night, something that you worry about when you look at the way your program is designed and your strategy and the markets and the way the world is today? I mean, is there something that you say, I don't really want this thing to happen, that I'm not saying you're going to lie, you have sleepless nights, but...
By the nature of what we do, the bad periods for us are a bleed over time, and the good period are the big shocks. So if I were, a manager, let's say if I was managing a hedge fund that is your typical long risk hedge fund, I would certainly be very worried every night that, one of a million different exogenous events can happen, and I can wake up to a 20% loss.
Yeah.
That type of event can never happen in our strategies because, by definition, any exogenous type event like that will be hugely beneficial for us.
Right.
We benefit from the sudden event that keep people awake at night. And the way we lose our money is really not with any fireworks, but the lack of.
Right.
So it's sort of death by 1,000 cuts, not explosions.
Right.
I actually, I might stay up at night hoping for an event like that. Not
Maybe that's what keep you awake. The fact that nothing
keep me up at night.
Exactly, nothing is happening. But no, that's interesting. That's a good way of looking at it. Now, just sort of one other topic I just want to touch upon. I know we've already talked about it. It's a little bit about research. Investors, they want us to do research. They want us to innovate, but they don't really want us to change. We have a certain profile, and you've explained that when you do implement things, it doesn't change the overall profile. So that I understand. But I want to ask you a little bit about back tests because, when you do a back test and when you finally come up with something that looks promising, it obviously looks good. That's the nature of the beast. But things does not always work out as the back test suggests. So how do you balance, or how much weight do you put on a back test, and what other things? It could be intuition, I don't know. But what other things are important for you when you sort of make the final decision in saying, yeah, this model I really like and we should use that?
Well, I mean, you can't really blame the back test. The back test,
exactly.
The back test is just sort of what you put into it.
Yeah.
Obviously, garbage in, garbage out.
Yeah.
99% of the work goes into happens before you go into a back test.
Yeah.
And what I mean by that is, look, again, it's a continuum, meaning if I take very simple strategy that's 50-day breakout strategy. Buy when you break on the upsides, reverse and sell when you break on the downside. And I put this into a back test. It's going to give me what I believe is the highest confidence level back test I can find.
Yeah.
This is, it's as pure a beta as you can find. Even in that backtest, I mean, it's still not going to cover every market condition that can happen. So think of it very simply, again, going back to 2008. If you run that backtest, up to 2007, you're going to have a certain risk return profile in it. But then you add 2008 to it, and all your stats is going to start, lighting through the roof. Although it would have been very positive and making money, but again, it's not going to be true to the backtest because it's going to make different, extremes.
Yeah.
So if I think of this simple 50-day breakout strategy as one end of the spectrum, and then the other end would be the completely overfitted, strategy that, will give you the 4 sharp.
Yeah, exactly.
But from day one, it will never work.
Yeah.
Where you want to be is obviously a lot closer to the first one than the second one. So how do we do this? One is, you want to think of the number of variables and parameters that go into your model as each one being inversely proportional to the number of degrees of freedom that you're putting into your model. With each additional parameter that you're putting, you are lowering the number of sort of the degrees of freedom that your model can have to react in different market conditions. Again, taking it to the limit, put 1,000 different parameters, you can get a model that never loses on a back test, but will have 0 chance of winning. So kind of that's the first layer that you look into it. But then, even with kind of lowering some of the parameters, you could always try to solve for the perfect parameter. And sometimes that perfect parameter is actually a singularity, or close to being a singularity, where if you start deviating a bit to the left or the right, it completely breaks down. So you can easily fix for that for each parameter you're looking at, making sure that any marginal change in that parameter value up or down by 25, 40, 50% is not going to have any significant effect on your portfolio, meaning you're not really backfitting to that one exact parameter that made things work for this. There is some level of comfort. So there are different techniques that you can do that you have to do before you get anywhere close to a back test that, again, will ensure not that the back test is going to be sort of the holy grail, but that it gives you a fairly good estimation of what your risk return profile should be. And again, it's subject to what the markets give you.
Sure. Do you ever feel restricted in your research because you have this, I guess, objective of creating a program that does well, kind of a portfolio protection type program, if I can call it that, and that obviously puts in some limitations, I would imagine. But did you ever feel restricted in your research, saying I'd love to put that in, but it just doesn't fit with my?
No, because we don't. We don't think like that. What we do is, in research, we go wherever research takes us. And again, we try to achieve our negative correlation in Conquest Macro by doing a lot of asset allocation. However, we also have another program called Conquest Star. Conquest Star, which stands for short-term absolute return, is essentially a version of Conquest Macro with only the absolute return mandate.
Right.
It's a short-term strategy that doesn't have performance and risk aversion mandate. So there are certain models we come up with that might go in Conquest Macro as where we'd only turn them on in one environment or the other, but can go into Conquest Star as a full-fledged model. So we go where the research takes us. Then, again, going back to the concept of the Lego pieces, you keep building those Lego pieces as best as you can, and then you use them in making the different portfolios afterwards.
Yeah, sure. I want to shift gear on you again, Marc. I want to go to just a few things on sort of, I call it the business side of things, and then at the end we'll finish off with some more general and fun stuff. But I just want to hear your view and opinion. I mean, on one side, the markets have been challenging and therefore, many strategies have had a challenging time in the last few years. But there's also a business side to what, you do as a manager. And that's, because you're an entrepreneur, so you're running a business at the same time. What has been your challenges as a business, do you think? And how is business?
Well, look, obviously, it could have been a lot better. We're used to being in the kind of space that we're in, which is the trading world space.
Sure.
I would say that even though we have strategies that do, we have funds that are ready to be launched and strategies that do well in risk-seeking periods as well, really our bread and butter is still coming from the Conquest macro side of the world.
Right.
Now, so when you're starting off with a strategy that really looks great only about 30% of the time, and the other 70% of the time you're playing defensive, you're already used to some of these ups and downs.
Right.
Now, what makes this particular stretch more painful is just the length of it. Because in these 6 years that we've been, not 6, but maybe since 2009 or 5 years, we should have had at least a couple of really nice moves into risk aversion, which we didn't have because of the global central bank action. So it's been a particularly long period of drought. And look, let's be frank, a lot of funds like us have gone out of business.
Sure.
And some other ones decided to change their strategy and do other things.
Sure.
We're lucky enough to have investors stick by us. We're still around. Obviously, we're not making the living that we made in 2008.
Sure.
But it's the nature of the beast.
Yeah.
Sometimes you go through good periods and you go through bad periods. Mm-hmm. Now, what I'm hopeful for is that I think this massive compression and sell-off in vol and intervention and everything is setting us up for something that will rival 2008, if not worse. So I think whoever is left standing when we finally turn the corner on this will end up being in a very, very good position.
You mentioned something which I think is interesting, and the whole explanation about the businesses, and it goes in cycles and so on and so forth. I don't want to put any words in your mouth, but you probably could have retired a few years ago and not going through all of these phases. But so I'm interested in what motivates you, what keeps you going, what makes you want to come in every single day and do what you do.
I can't think of anything else I would rather do. That's one. Yeah. My wife would kill me if I spend my days at home. So I kind of have to leave the house. No, right. But on a more serious note, look, it's even in its worst days, it's still the best job in the world.
Right.
It's very dynamic. It's exciting. Things are things are moving all the time. You're working in things from research to trading ideas to looking at the markets and how what you've done before is working. So it fulfills you on so many different levels. Now in a way, most jobs should do that. I think what this does is it has much higher highs and lower lows.
Right.
So it's very addictive, but in a good way, I would say.
Do you remember how you got your first investor?
Yeah. When I left, I told you I partnered up with a friend of mine, sure. And I had gone from running, this global group at UBS and having a huge team all around the world. And I remember me and my friend were sitting at we rented a one-room office on Park Avenue that we just carved out, a small conference room from it, just big enough for the conference room table.
Right.
But it was really a one-room office. And on a Friday night, I think it was, we were sitting and building desks that we bought from Staples. I didn't know that they don't come assembled.
Right.
So, and, at that point, sort of, sitting there, it's like, am I sure I'm doing the right thing? Sort of when it hits you a little bit. But no, there's no doubt really about, that step. But look, I put in my own money. My partner at the time put in some of his money. And that's how we started. I think, when we started, it was like, I think $3 million or something.
Right.
And just through contacts. I mean, look, I miss those days because back then, even in that one-room office, we started trading with our own money. But pretty much we got any investor, people at the time, and this is, it's not so long ago.
No, it's not.
1999.
Sure.
You met with the people whose money it was.
Yeah.
And typically these people didn't care what your office looked like or how many people you had or what art you had on the wall. They came and they spent 2, 3, 4 hours with you. And if they believed in you and what you're saying, they gave you money. And if they didn't, then they passed. But there was no bullshit.
Yeah.
It was, really about the strategy and about what you're doing. Unfortunately, that doesn't exist anymore now.
Right.
Now there are so many layers in between you and the ultimate investor.
Yeah.
Whether there are many different professional like investment due diligence people, and some know their stuff. A larger majority of them doesn't. They come with with a list of boxes they need to check, without really fully understanding what is it that you do. So in a way, it was more fun before, and in a way easier.
Yeah.
And right now, that sort of shifted from investors really looking and delving into the strategy to right now, more sort of the herd mentality where either, the big funds get bigger because no one gets fired, for buying IBM.
Sure.
Or, you have to put in really outsized type returns for a year or two before, then they come and they buy the return again without really understanding what caused those returns.
Yeah. And that's a perfect segue to my last question in this section. And that is really, you've obviously been, part of hundreds, I'm sure, of due diligence meetings and answered, thousands of due diligence questions, even though probably most of them are the same. But I want to ask you, what are the investors forgetting to ask? What are they not asking you that they really should be?
It's tough to answer that question because due diligence meetings now have stretched to that 4 or 5 hours.
Yeah.
And then not only investment due diligence, then you have operational and you have legal and all that stuff. So I think most of the relevant questions are being asked. What I'm not sure, though, is what people are doing with those answers.
Right.
I think the questions are there, but I'm not as sure that someone is kind of processing all the answers in the right way.
Yeah, I mean, my own impression is, and that's one thing I don't know if I've ever been asked by someone coming and doing due diligence, and that's the why. I mean, they ask a lot of what and how we do things, but they never really ask why we do it. And I think that's missing, because I think that's what, if people understood the why, they would have a much easier way to, one, communicate it to the investment committee, because usually the investment committee members are not really present anymore. But just also generally to understand the business as such, because at the end of the day, the only thing that differentiates one manager from the other, it's the manager themselves. And
no, so absolutely. Yeah. I mean, whether it's systematic or whether it's discretionary, it really boils down to the manager. I mean, in my mind, I don't see a difference between these things. Ultimately, it's the person.
Yeah, which is also why I end up with this section called General and Fun, because this is where, Marc, we really get to know you.
Okay. I'm scared now.
Yeah, you're scared now. That's right. No need for that. No, I just want to ask your opinion. We've touched upon it in different ways, but there are many people listening today who maybe want to find out about what it takes to become a great trader and so on and so forth. So, from someone who's done it over a long period of time, what would you say it takes today to become a great trader? What are the personal traits that you need to possess in order to achieve that?
Well, first, thank you for the compliment, but I wouldn't presume I'm there yet, so I'm still looking with the rest of them.
Sure.
But I'll tell you, discipline.
Right.
Discipline is extremely important. You need to have not blind faith in yourself. One should always question what they're doing, but you really have to have the ability at tuning out the rest of the world around you to the point where you're comfortable saying, yes, 90% of the people or 95% of the people are wrong and I'm right. It's not very easily done. It takes, I don't know whether it's hubris or what do you want to call it, or, thinking of too much of yourself. But look, it takes a real sort of combination in between having the right discipline to question certain aspects of what you're doing and how you're doing it, but also the fortitude to stick to your guns.
Right.
You get so much unsolicited advice at the top and the bottom and all points in between.
Yeah.
And you have to be able to really process the information without the noise.
Sure.
You need to start with some level of talent, but very importantly, you need to be able to complement it by having the right people around you.
Right.
Successful traders are successful because they're good at what they do, but also to a large extent, they've surrounded themselves with people who maybe are even better than them at what they do.
Sure.
I have no problem hiring people that I think are better than me.
Yeah.
It just makes the whole thing more enjoyable.
Sure. To keep the noise out, as you say, do you have any personal habits that you do that helps you do that on a daily, weekly, monthly, whatever basis, and that you would say has contributed to your own success?
Well, look, I'm really a trader at heart.
Right.
I use quantitative techniques to implement my views. Whenever those noises are sort of really loud, it's going to sound very strange, but I find it very therapeutic and much more sort of calming to go back and look at the markets, look at the charts, look at our stats, look at the models, how we're doing. It's a way for me to remember how much work we've put into what we're doing, and what we're doing to make sure that we're still kind of there is we believe that the models are still performing the way that we expect them to. So it's more of diving deeper into the things that are causing that pain at that moment. But if you've done your homework right from the beginning, it gives you a certain level of comfort.
Yeah, absolutely. Now, in a long career, there's always going to be highs and lows, and there's always going to be things where you said, yeah, I did that well, and there's going to be things where you said, no, I didn't do that well, I failed at this. Is there anything where you can look back and say, what your biggest failure have been and how you ended up overcoming it?
Well, a couple. I can go on for a lot.
No, most people can
I'll choose the two big ones.
Sure.
If I could go back and do it all over again, I'm not sure I would choose to be in a risk-averse strategy.
Right.
I think it's very important in a portfolio, but you inevitably end up being the person, late at night in a party, going around and telling people to stop drinking because they're going to get a hangover.
Yeah.
That's a boring person. No one wants to hang out with them. It makes it a much tougher sell to do what you're doing. I mean, I have the same skill set that sort of allowed me to do what we do here. I could have used it on the long side of things.
Yeah.
And I think it would have been a much, much easier path and probably financially a more successful one. Because what ends up happening is, look, when you're in a long risk strategy, you're making money when everyone is making, but you're also losing money when everyone is losing. So you share the highs with a lot of people, but you also share the lows with a lot of people.
Sure.
In what we do, when things are, great for us, is when they really are horrible for everyone else, so you can't even celebrate. But also, when you do your best, in a year like 2008, you still end up suffering significantly because you become the ATM machine.
Right.
We've had, we were up over 50% in both of our program in 2008, but still saw our assets being cut in half.
Yeah.
So that's one. And more, on a portfolio basis, we've done a lot of things that in retrospect were not the best thing to do, and we've undone them.
Right.
I think that's sort of part of why I think today we have, the best portfolio we've ever had. It's because, of all the mistakes we've made in the past and what we've learned from them.
Yeah. No, absolutely. That's a good point. I've only got two more questions that I'd like to ask you, Marc, and that is there a fun fact that even people who know you don't really know about you that you can share? And I've had very varied answers, so anything goes here, I think.
Fun fact. I have to think about this one. My kids think I'm a lot of fun.
Sure.
I love to do dangerous things.
Right. Okay. Give me an example. What's the dangerous thing?
Rock climbing.
Okay.
Flying a plane. Jumping from a plane. That kind of stuff.
So there is a danger side to you.
It's more sort of I wouldn't do anything that I think truly is dangerous.
Right.
I tend to be very risk averse when it comes to that. But I think, just looking at the probabilities,
sure.
Why people might perceive to be dangerous is actually, fairly safe thing.
Now, my last question, Marc, I asked you earlier about investors not asking the right questions or failing to ask important questions. So I want to put myself in, on the spot as well and ask you what I failed to cover today. I know that we can't cover everything, but is there anything that you think I missed and that you want to bring up before we end, to do justice to yourself and to Conquest?
Look, I think you asked all the right question in the time that we had, which is, as long as it has been.
Sure.
I'm sure we could have taken another 4 or 5 hours and talked about the rest of the stuff.
Sure.
As you can see, I'm fairly passionate about this. So when I start talking, I can't stop in some cases. But no, I don't think there is anything glaring. But just by nature of how wide-ranging the topics we discussed, each one of those we could spend another hour or two on.
Of course, absolutely.
But that's not for lack of you asking the right question, is more of just timing.
Sure, absolutely. Well, before we finish our conversation, can you tell our listeners where they can best reach out to you and learn more about Conquest, please?
Of course. Our office is in New York City. We're Midtown, sort of hedge fund central. Our phone number is 212-759-8777. My email address is M as in Mary, H Malek, Malek, at conquestcg for capitalgroup.com. If anyone has any question, comment, or they can feel free to send me an email, and I'll either answer it myself or route it to the right person.
Fantastic. And of course, all of these details will be in the show notes on the toptradersunplugged.com website as well, Marc. So I also want to say one other thing to the listeners, and that is in the email that we send out, there is going to be a little place where you can just click to thank Marc for sharing his story and his expertise. And I encourage everyone to do so. And I'll certainly be the first one to say, Marc, thank you ever so much. I think it's been a great learning experience. It's been a great conversation, and I appreciate your transparency and your willingness to share these insights about your strategy and your firm and the industry as a whole. So I really do appreciate that.
Great. Thank you very much. Appreciate your time and the listeners' time.
And I hope we can connect at a later stage and see how things are progressing at your end, and maybe dive into some of the topics in even more detail than we did today.
Absolutely. Thank you, Neil.
Great.
Bye-bye.
Thank you. Take care. Bye-bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.